Joined live by Shane Oliver. He's the Chief Economist at AMP. Shane, thanks for your time. This number today, will it give the RBA enough to pause on the rate hikes next week?
Look, I think it does, and I think it will. Obviously, the Reserve Bank will still be concerned that inflation is still too high, and obviously it's still concerned about wages growth becoming excessive. But that said, these numbers were quite a lot lower than expected. It means that the quarterly number will probably come in less than the Reserve Bank expects, and I think that gives scope for the Reserve Bank to at least pause its interest rate hikes next week.
Are there other numbers that point to a similar direction, that those rate hikes are biting already, Shane?
I think there's a lot of evidence that the rate hikes are biting. We've seen real retail sales, that is, the volume of retail sales are now falling. We've seen a sharp fall in home construction-related indicators. We're seeing signs that business investment plans are starting to slow down. We've seen an increase in corporate insolvencies. We've seen a big slowdown in GDP growth. All of those things are telling us that the series of rate hikes that we've had, 400 basis points, is starting to bite. And I think it's only the risk is increasing that if those rate hikes continue, and we may have already seen enough to do it, that we might tip into recession as we go into next year.
Where would you put that likelihood now as we speak this afternoon already with the cash rate at 4.1%?
Look, I'd say it's 50-50 at present. If I look at a range of indicators, they're all pointing down, but they're not yet decisively at the point where you'd say a recession is a certainty. But that risk is very, very high. And the big unknown here is the household sector, which has been propped up to some degree over the last 12 months by pandemic-related savings and the reopening of the economy. That's going to come to an end. You've got a whole bunch of households out there who are going to be badly affected by these interest rate hikes, and that's going to lead to a big hit to spending going forward. So that's where the big risk is. It's the household sector, consumer spending over the next 12 months. But I'd say the risk of recession is around 50%.
Okay, well, there's been a lot of talk about that buffer built up during COVID, but you think now that buffer for households is gone?
Yes, it's gone, if not running down rapidly. If you look at the household savings rate, it is now below where it was prior to the pandemic. In other words, that big boost to savings that we saw through the pandemic has now reversed. And I think the other aspect is that we've heard a lot over the last 12 months about revenge spending, revenge travel. Those things are still ongoing, but they're starting to fray at the edges. And I think obviously higher interest rates are having a big impact there. But the reality is that when you raise interest rates like we have so aggressively, the most aggressive rise in interest rates since the late 1980s, you do run a big risk of not allowing for the lagged impact of those rate hikes, and therefore you end up potentially in a much harder landing than might otherwise have been envisaged. And that's exactly what we saw at the start of the 1990s after those massive rate hikes at the end of the 80s.
On a lighter note, and a brighter note for many, if you've been able to get tickets to Taylor Swift already, I know it's a bit of a discussion right around the country right now, but you made some interesting and amusing remarks in the AFR today that this is not something we should worry about in the context of inflation. Just enjoy a bit of Tay-Tay.
That's right. I mean, I must admit I'm feeling kind of depressed right now. I tried to get in. I actually got in. I was in the sale queue, actually got in. And then when it came to put in my Ticketek account details, I forgot the password and then sought to renew it. And by the time I managed to renew it, I'd been timed out. And so that was the end of that. So I feel like kind of depressed about the way that's turned out. And I've had other colleagues suffer similar fates, getting timed out before they could actually take advantage of it. So a lot of people are going to be feeling happy today who got in, but a lot of people won't feel so happy at all. But I think, the key is that if Taylor Swift's visit does result in a pickup in inflation, for example, that Beyonce effect that we saw in Scandinavia a month or so ago, if that occurs, then the Reserve Bank should rightly look through it because it would be a temporary boost. Even though I might be feeling happier if I do get to go to a concert, and I'll try later in the week again. But I think the broader picture is you have to allow that any Tay-Tay lift to the economy, or T-Swift lift, as they're calling it, would be a temp. I don't think it would be enough to head off any recession, and certainly not enough to reverse the downtrend in inflation.